Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. My name is Goose, and on today's show, we had a repeat guest, Tim Keating from Dashdot. He was formerly, last time he was on the show, was a property acquisition analyst, and now he is the head of our property team. And we talked about what is actually going on in the market today, buying properties on the coalface in the current environment with rate rises, with the media saying the property market's going down, all of that kind of stuff. What is actually happening on the ground around Australia? We talk about that. So if you're interested to know what it is actually like at the coalface, right in the pits, in the firing line, to see what's actually going on the ground and how you can navigate it to be a more successful investor, then this is the episode for you. So without any further ado, I'm going to get stuck right into it. And of course, just remember, if you like this show, this podcast, or you like your family and friends, make sure you share this episode or another episode with them. Share it on social media, share it wherever you can, because that helps us get the message out to more and more people. And of course, if you've got a question that you would like answered on the show, please email that into TIL, that's TIL at dashdot.com.au. Send it in. We can answer your question on the show as well. Without any further ado, let's get stuck into it, and I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me on today's show is actually a repeat guest, Tim Keating, who last time he was on the show was a property acquisition analyst, but who is now head of the property team. Tim, welcome back to the show. How are you?
Good, Goose. Thanks for having me, mate. Great to be back.
Awesome, mate. So what's been happening since last time we spoke?
Oh, mate, a hell of a lot, actually, since we last spoke. I think I was in Darwin, and it was around, would have been around October, I believe, late October. So since then, we made our way across Queensland, and we did a trip up the coast and visited all of our properties that we've purchased and seen them for the first time.
Cool.
The first few we were really surprised with at the quality of them, and we thought we'd done quite well. The last one that we came across in North Queensland, we bought a fourplex in Townsville. We weren't so happy with the condition of it, but we got stuck in, and we just did a 6-month renovation. Just to be clear, though, you knew that it was a bit of a fixer-upper when you bought it. Oh, absolutely, yeah. We knew that we were in for a long haul, but after seeing the condition of the first two, and going, wow, these are better than we thought, and then getting to Townsville and seeing the state of the last one, it was a bit of a reality check in terms of the work that we had ahead of us. Mm-hmm. But yeah, we did buy it as a fixer-upper, and have spent the last 6 months doing a massive renovation on that. So that's what we've been up to. Awesome. I'd love to dig into that, but should we dig into that? Because I'd be interested to know. It's probably good for the listener to learn how that went, and how did that work out? Really good. I can run through the numbers if you like. If you want me to, go for it. And then because I want to talk to you about what's going on what's going on out there in the market. But yeah, give us a rundown how that deal worked out. Because I know it caused you a bit of pain, but I think it's turned out all right. Yeah. So we bought it for $625,000. It's a 10-bedroom, 4-bathroom, 4-garage fourplex. So there's 4 units. 2 of them are 3-bedroom and 2 of them are 2-bedroom. Mm-hmm. We spent $110,000 on the reno, doing the majority of it ourselves. Yep. Hang on. What was the purchase price? The $625. $625 purchase price, and then how much on the reno? 110 was it? 110. Yep. Yep. See, that way means you're up to 735. Yep. Yep. It's currently all 4 units are currently rented. Yeah. And we're getting $1,430 per week in rent. $1,430 a week. Yep. On a $735 spend. Yep. Mm-hmm. Which works at about a 10% yield. Crikey. Yep. And we've just had a val at $850. Boom. So we've had a good little equity uplift. Yeah. And even with new adjusted interest rates, it's still kicking out $28,000 a year in cash flow. That's pretty bloody good. So, okay, so you made about 115 grand in equity, and you've gained about 28 grand a year in cash flow from that deal. Yeah, correct. So it's absolutely crack a deal. Lots of work, but happy with the result for sure. Would you do it again? I would, yeah. 100%. Absolutely, I would, yeah.
Yeah, interesting. Yeah, interesting. All right, awesome. No, I love that. Yeah, because it's definitely was a bit of a bigger project than you originally thought. But mate, I'd love to what I want to do is I want to talk to you today about what's actually happening out there in the market. Like there's a lot of talk right now, particularly in the media. Property market's crashing, boom's over, interest rates are going up, can't afford to buy. You know, there's no demand anymore. If you listen to the media, you know, you're hearing things like auction rates are down and, you know, listing volumes are up and all of that kind of stuff. And there's nothing that no one's buying anything anywhere or any of that kind of stuff. And so it makes it sound like it's a terrible time to be an investor. But I would love to, given the fact that you're at the helm of our property team, who are out there every day looking at properties in the marketplace, finding deals for our clients, all that kind of stuff. Mate, can you give us some insight? Tell us what's going on.
Yeah, don't believe the media. I mean, you see all the clickbait headlines everywhere these days, and you know they're not selling as many newspapers as they used to, so they've got to make money from clicks and advertising and all that sort of thing online. So they'll write anything to get you to go and read it, essentially. And I can tell you that the markets that we're buying in have definitely not cooled at all. There's definitely some areas in Australia that have cooled, but we're not buying in those areas, and we buy in areas that have got solid foundations and fundamentals. And you might see that some capital city markets, Sydney, Melbourne, potentially have started to decline, or the heat has sort of come out of the market a little bit.
They have started to decline. So Sydney just recorded dwelling values that have dropped. Now, interesting thing about that is that, you know, I can't actually remember off the top of my head how many different suburbs and stuff there are in Sydney. But interestingly, some suburbs in Sydney are still going up in value, and some suburbs in Sydney are going down in value. But on aggregate, Sydney's gone down in value, and the same thing goes in Melbourne, and the same thing in Canberra. Again, some parts of Melbourne are going up, some parts of Canberra are going up, but on aggregate, they're going down. The problem with that, though, is that the market cap of those locations is so big, like the total aggregate value of properties in those locations is so big that if they start to go down, everyone thinks that everything's going down, you know. And this is kind of the problem. It's kind of like if you looked at the ASX and you took the largest companies in the ASX for example, if you just, people hear it all the time, like with Tesla, for example, if Tesla goes down in value by 10%, then the whole NASDAQ goes down in value, sort of thing like that. So if you imagine if BHP went down by 10%, you know, so this is the kind of the myth that I think is out there. So the values are going down in some places, but they're always going down somewhere. This is what people are missing.
Yeah, 100%. And I mean, yes, there was a property boom, and the myth at the moment is that we're still in this property boom. But the reality of it is the property boom only lasted for a specific timeline, and I'm sure you've got the numbers on the particulars behind that. Yeah. And you know, we've got evidence and data that shows that everything, or the majority of properties in the property boom areas continued to rise, and then as soon as the boom finished, they've started to decline. However, if you graph it out and you look at the areas that we're buying in the suburbs that we're buying in, that property boom cycle had zero effect on the trajectory of the areas that we're buying in. Yeah, they were going up before, they went up during, they're going up after.
Yeah, it's pretty interesting, isn't it?
It's amazing. I love those graphs. So yeah, I'm sure you can speak to the numbers better than I can. But
totally. Well, it's a really interesting point that you made, because everyone keeps going on about a property boom. And yes, absolutely, there was a property boom. And in fact, if you look at the data for 2021, you'll see that the significant, I think it was 84% of suburbs in Australia grew by more than 7%, 7% being roughly the long-term average of growth over the last 30 years in Australia. So use that as a bit of a benchmark. I think from the top of my head, it was about 84% of suburbs grew by more than 7%. So, okay, that's pretty hectic. But in practice, the actual boom only, as defined by the median national sales price and growth, only went for about 7 months. So in September 2020, we had national property price decline, right? In September 2020. Okay, so that's obviously not a boom because prices went down. And then in May 2021, the growth rates peaked. From May 2021, the national median growth rate has actually been slowing down. So in actuality, we've been on the downslope of the boom for a significant amount of time, and that's kind of played out through 2021. But if you also then look at the numbers about the percentage of suburbs that were going down versus the percentage of properties that were going up above average and versus they were going up at a normal rate, if you compare that with 2019, 2020, and 2022, you'll actually find that we've actually basically just reverted back to a pretty normal distribution of areas going up and down. So that's pretty interesting. So tell us then, like, what's it actually like when we're trying to buy properties out there? Is it like,
it's hard.
Why? What's going on?
It's a hard slog. There's I don't know why. I mean, obviously where we're buying, they have a lot of upside. The areas that we're buying have a lot of upside.
Yeah.
There's lots of owner occupiers. There's lots of investors on the ground trying to buy. We're in multi-offer situations 9 times out of 10 on basically every property that we're trying to get our hands on, and that's because we buy the best.
Which is
properties.
suboptimal. It's suboptimal. We would way prefer not to be in those environments, but
absolutely.
But at the same time, if they're the best places to buy, then anyway, keep going.
Well, we're buying the best properties in the best locations. So there's of course going to be other people trying to do the same thing, right? Trying to buy the same properties that we are. So unfortunately, we're in multi-offer situations more often than not. We've had to change our tactics somewhat, constantly grinding out, trying to figure out the best way that we can have the most success on the ground. But, things are going over asking in just the amount that some of these properties are going over the listing price is just insane. But, we obviously pull out where we don't see value and we don't think it's in the best interest of our clients. Yeah. So we're in a tough spot in terms of the ability to purchase effectively in some locations, but the good thing is there's always others popping up that are getting added to the list of suburbs that we're actually purchasing from.
Yeah, totally. So does that? I haven't had a look at the data on this, but does that mean that the vendor discount rate is actually inverted in a lot of locations?
Yeah, it is. So I think I had a look at the April median vendor discount numbers the other day. Some of them are above 15%, so minus 15% discount. So going 15% over asking price.
Okay, so for the listener, just to get you up to speed with what we're talking about here, there's a measurement called the vendor discount rate, which basically measures what percentage above or below the asking price the vendors actually sell for in an area. So if the vendor discount rate is high, right? If it's like say plus 10%, then that means that the discount, it's on average properties are getting discounted by 10% from the list price, right? But if it's negative 15%, that means on average properties are selling for 15% above the list price. It's a negative discount rate. So when the discount rate is inverted, when the discount rate inverts, that's a sign that it's pretty tough. That's a pretty tough environment to buy in.
Yeah, 100%. And it's the funny thing is you see these articles online about, clearance rates at auctions decreased or fell for the first time X amount of months, and you see all the laughing emojis on the ads and all that sort of thing. Like people want to see the market come down, and they're calling investors stupid, and there's all sorts of commentary on the articles. But if you look at it from the other point of view, where we're not buying in these capital cities, we're buying in regional markets that have got super strong fundamentals that are going up and up and up, and we're getting 15% over asking price. It just shows that there is no one Australian property market. Yeah, and that every single market's unique and individual. And we've chosen these locations based on those factors.
Yeah, 100%. Yeah, there's 15,264 towns and suburbs in Australia, and each of them act independently. It's pretty interesting when you look at the heat maps and stuff over the last 30 years. And so, Tim, like from your perspective, you mentioned earlier about interest rates. You mentioned about your cash flow and your property and how, like you're still getting tons of good cash flow out of that property from there. So I'm interested to know from your perspective, have you seen, we've obviously had a couple of interest rate rises recently, and a lot of people are concerned about that. Can you tell me what impact have you actually seen on the coalface, like on the ground in all the locations that we're buying in? Have you actually seen any impact of interest rate rises on the actual ground? Like, is it changing how people are buying? Is it making it easier to buy? Is it harder to buy? What's the impact there? And then secondarily, has it had any impact on, in your opinion, a property purchasing strategy or the types of properties we might need to buy or any of that kind of stuff for clients?
All right. So firstly, we'll talk about the heat in the market. Mm-hmm. So there's been a negligible effect. We have noticed no decrease in the heat on the market. Competition's still there. We're still in multi-offer situations. If anything, it may have even increased since the election sort of calmed down. Yeah. The good thing is when interest rates rise, rents also rise. Over the past 12 months, we've seen in the areas that we're buying 20 to 25% rental increases. And if you look back at the property that we purchased, we were anticipating rents to be in the range of $1,200, and we're at $1,430 per week.
Unreal.
And that was since we got a rental appraisal 6 months ago. So it's a huge increase in rents just in that particular area. And the forecasts are that we're going to see, I think we saw an article the other day, was it 10 to 18% over the next 12 months?
Yeah, I think so. At the moment, most regions in Australia, most areas in Australia have been growing at an annualized rate of 10 to 20% per annum for the last, I don't know, like year or so. So rents have been going up by that much, and they're forecast to pretty much do exactly the same thing for the next year. And this is the interesting thing about this, is that I actually don't know if that is going to change anytime soon. Like I think that's obviously it'll start to soften after a while, but that could be years. You know, like we're actually seeing that, and this is actually a global trend. This isn't something that's specifically unique to Australia. Like people think that when people see change, when they're like, oh, but rents should be rising by 3 to 5% a year. That used to be the kind of prevailing logic, is that rents would rise between 3 to 5% a year. But in practice, they've been rising by 5. When back to 2019, they're rising at about 5%. Then it's 10%, and it's 15%, and 20%. Right? Here's the thing: it's speeding up. People see situations like that, and they're like, "Oh, this is just a weird anomaly." But it's actually happening everywhere. If you look at the States, if you look at the US, the exact same thing is happening in the US. And in fact, rents are in almost all areas in the US. Rents are going through the roof over there as well. Same thing's happening in Europe. And the reason for that, like the really basic, fundamental reason for that, you know, the biggest catch cry of real estate is, you know, they're not making any more land, buy land, they're not making any more of it, blah, blah, you know, all of that kind of stuff. Everyone's kind of heard that kind of stuff before, but it's actually true, right? And so when it is actually true, and the government can't just continue to release more land because guess what, to development, because guess what, we need to be able to still produce, we need to still have forests, we still need to be able to have farms, we need to have all that kind of stuff. It does actually limit the capacity to be able to continue to build more properties. Not only that, we've got supply chain disruptions, right? So that simple fact means that we're continuously squeezing the housing supply, which means prices go up, which means it's harder for people to get into property, which means more people want to rent, right? Which drives rents up. It's pretty simple. So yeah, this is happening all over the place. So back to your point, yes, it is forecast to continue for like at least the next year.
And I guess one other thing that we've noticed in the market too is less competition on higher priced items.
Interesting.
High priced assets. So
when you say, when you say higher price, what do you mean by higher price? Because I was reading in the paper the other day about a house in Mossman selling for about 23 million, right? So that's that's a higher price property. How high are we talking here?
Well, let's just look at like, let's say you're living in a city, right? And you're looking at buying a $1 million property. That's fairly cheap for a CBD. Whereas the areas that we're buying in, a common purchase price is sort of $250,000 to $500,000. So very affordable, lower debt levels. So we're having, you know, less competition for the high. When I say high priced, I'm talking about $1 million asset in these areas that we're buying in, and much more competition around the lower price sort of entry level investor market.
Yep.
And I think we'll see that continue. And it's not just investors; it's also the exodus from the cities into the affordable lifestyle. I think that's just going to continue. You know,
totally.
It's, I mean, obviously, I'm traveling around Australia in a caravan, so I've got a bit of a thing for being remote and you know, the whole lifestyle factor around it. But I think that the further we get through time, the more people are going to realise that they don't need to be living in a city, and they can live wherever they like. You know, you're a prime example of this. We're having a company where we have a work from anywhere policy, or a work from somewhere policy is the way we look at it, I guess. But exodus to affordable lifestyle and being in the regions and rural areas is just an awesome lifestyle boost.
Totally. It's a huge one that people are missing, right? So I read a actually it was an ad for like some kind of like co-working space type thing, and it said commuting is unpaid overtime. And I was like,
that's true.
Yeah, that is very true, isn't it? Now you can choose. Me personally, I don't really want to like live in a small country town area. I grew up in a small country town. It's not my vibe. Maybe sometime later on, all good. I actually prefer to be, you know, in an environment that is somewhat has like some kind of cosmopolitan features. I like, you know, restaurants and stuff like that. That being said, that doesn't mean you need to be in like Sydney, for example, for that, to get that, because you can get that all over the place, right? And in fact, you can get that by going all over the place, which means moving around a lot and renting loads of different places. And so the exodus to affordable lifestyle isn't just about people moving to the country and buying houses in the country to live in. It's actually exacerbated by the idea that people now have a smorgasbord, basically a degustation platter of opportunities to live in. They can go, yeah, you know what? I'm going to go live in the Sunshine Coast for a year, and then I'm going to go live in Perth for a year, and then I'm going to go live in, I don't know, Adelaide for a year, and then I'm going to go live somewhere else for a year. And the whole time, because they've now got that optionality, they're actually choosing to rent more. And this is actually like a massive mega trend, access versus ownership. And it's the same argument that actually, it's the same mega trend, that actually fueled Uber, right? So it used to be everyone wants to buy a car, everyone wants to own a car, everyone wants to buy a car and own a car. And then Uber came along and said, you don't need to. And like, to be honest, I was looking at buying another car recently because, I don't know, to be honest, I was a bit bored, right? So I was like, yeah, man, maybe I'll buy a car. Then I was doing the maths on it, and I was like, I could literally get an Uber Premium every single day, and still it like makes more sense than owning a new car. I was like, what the hell, right? And so you got this access versus ownership discussion, and when you can choose to have the life that you want with the absolute optionality that you desire, it changes the game, which is even more reason why people are renting, and then that's even going to be even better for property investors.
Yeah, and we've seen this even amongst our own acquisition team. You know, we look at these areas that we're buying in, and we've been watching them for, say, 3-6 months, and then all of a sudden, some of the team members think, oh, wow, this is a pretty good place to live. I might move there. And we've actually got 2 of our acquisition team members that are moving to some of the locations that we've been purchasing in because, yeah.
Oh, that's awesome. I didn't know that. That's so good. That is so good. Yeah, look, the things that underpin this kind of stuff, right? And there's always going to be some degree of asymmetry, but it's always a combination of lifestyle, jobs, and affordability. Now, can you have a location which will be really strong because it's got affordability and jobs and less lifestyle? Yes, but if it's got no lifestyle, then it's probably going to be a little bit volatile. You still need three legs on the stool. And so if what the team is discovering is that actually I can rent a great place here and it's affordable and it's got lifestyle and I can kind of work and I can work remotely from anywhere as long as it's got good infrastructure, then mate, that's awesome. I'm super stoked actually to hear about that. You have to actually tell me where they're moving after. I don't want to give away the location.
100%.
Awesome. So, okay. So I'm interested to know, like, from a strategy perspective, like obviously we've got a lot of clients that we're buying properties for every day, every week, all that kind of stuff. From a kind of a mindset perspective, like how do you think people should be thinking about buying in this market? You know, there's obviously a lot of fear in the media. There's obviously a lot of like noise, negativity, all of that kind of stuff. And fear, just in case the listener don't know what fear stands for, it's false events appearing real. So how do you think people should navigate this kind of environment when there's a lot of fear in the market?
Yeah, cool. So my overarching mindset strategy here is that you've got to have a static mind to deal with a dynamic environment. And I can talk to this with an example if you like.
Yeah.
So when you've got a dynamic mind, you've got a lot of things going on, lots of different levers are being pulled, lots of different stresses are being added in. If you get other dynamic circumstances coming your way, you probably won't respond to them very well. So for instance, you might have been to the shops and you've seen a parent with all these kids screaming and carrying on, and you know, a few other things are happening, and then some external thing will come in and they'll just flip out and lose their mind, and it's just a knee-jerk reaction that they shouldn't have done that, basically. And that's because they've got a dynamic mind and they're in a dynamic situation and the two aren't working together. So you need to have a static mind where you have sound fundamental bases and reasoning to be able to deal with those external dynamic pressures and changing conditions. So from a real estate perspective, those changing conditions are media hype, interest rate rises, doom and gloom. But from a mindset perspective, we need to work off a principles-based approach. So we buy properties you have principles that will determine your choices, basically. Your tactics can change, but your principles remain the same.
So I love the sentiment, but it's interesting because I think you could also take that you could also look at it in a slightly different way, right? Because I agree that stillness is the key. And in fact, if anyone's looking for a good book on that topic, and particularly like the Stoic philosophy around that, then look for the book called Stillness is the Key by Ryan Holiday. In fact, there's another great book called Ego is the Enemy. Check that one out as well. Great books. So I believe that you do need to have a principles-based approach, but And that actually gives you the stillness in order to participate in a dynamic environment, right? Because if, for example, and I think this is your point, right? To have a static mind in a dynamic environment, because if you can have a calm and centered mind that can survey the landscape with the context and the comprehension of how to approach it in a principles-based way, then it allows you to be dynamic to the different changes. Because if, for example, we said, we're buying properties in Newcastle, right? And if we said that's our play, and we're just going to buy properties in Newcastle, then when you actually have external forces that might change, and they could be socio-political, economic, they could be demographic, they could be psychographic, they could be economic, they could be fiscal policy, government policy, any of these kind of things could change. But if you're too dogmatic in for example, nothing wrong with Newcastle, by the way, if you're in Newcastle and all good, not having to go to Newcastle, but if you've got a perspective that, we buy here, we do this, then when those other things come along, it's kind of like it's the old analogy is you want to be like a reed. When the wind blows, you want to bend with the breeze. You don't want to be like the oak, which cracks and breaks when the wind blows, right? So you need to have that dynamicism to say, okay, cool. How can I find the opportunities in today's market? That requires that you're centered. That requires that you're calm. That requires that you have poise, but also requires that you know how to shift and change and look for the right opportunities in the right place at the right time. Because it doesn't matter, honestly, it doesn't even actually matter. So what we said earlier is that some markets are going down and some markets are going up and all that kind of stuff. Can I just say it actually doesn't even matter if the markets are going up or down. What actually matters is that you can identify how to find the opportunity in the situation. Because even if a market is going down, there's opportunities in that market that you can take advantage of, as long as you can take a principles-based approach and stay calm in the torrent of noise. So what do you think about that?
100%. That's exactly my point. You've just articulated it better than I could.
No, that was shorthand for saying I just waffled on longer. That's all. That's all that is. So, mate, what about some? Have you seen any kind of success stories coming out of the market at the moment? Because a lot of people, again, they're hearing like, boom's over. No properties aren't growing anymore. Shouldn't be buying. Any success stories that you've seen? Recent ones like which might kind of challenge that view.
100%. Yeah. From a rental point of view, basically every rental appraisal that we get, we always get a low end and a high end, and we generally work off a $20 range. So for instance, it might be $480 to $500 per week. We base all of our numbers off the low end just to be conservative, and then maybe by the time it settles, the market's moved a little bit, and that the rent that we're actually going to achieve is higher. In about 90% of cases at the moment, we're seeing the rent that we're actually achieving post-settlement is above the high end of our rental appraisal. So we're going to clients and saying, hey, check this out. It's going to get $480 a week, and it looks really good on paper. And in reality, they're getting $530 or $540 a week. And this has just been a consistent theme across the board over the past little while. And, if we're doing a 42-day settlement, given the heat of the market and the rate at which rents are increasing, that's a pretty large chunk of time to give you an increased actual rent amount by the time we've settled.
Oh, right. I mean, I can talk from personal experience on that, because we bought a couple of properties in the last few months. We've had a few properties settle, and one of them we bought. I can't remember when it went under contract. I'm pretty sure it was about a 5.2% yield when it went under contract. And then by the time it settled, I think it was 5.8. Oh, actually, you know what, Tim? Actually, I'm just going to revise that, because I actually had a look at it yesterday. That property that I was just talking about there, actually went from a 5.2% to a 7%, because it's actually just been rented out at a 7%. And then there was another property as well, which we had settled recently, which we got so we actually bought it, and I'm pretty confident we actually paid over, we paid over asking price, potentially over market value if you do a comparative market analysis, right? So we certainly didn't buy it under market value. And in the 1.5 months since it settled, 5 weeks actually since it settled, we got a bank valuation on it the other day, just because, I just wanted to get some valuations on our properties. And it's we've actually made 100%, just over 100% return on invested capital on that property, and the yield has gone from an 8% to a 9.1% yield on that property. And it's like, what? Like, it literally just, we got tenants in it like last week. I was like, what the hell's going on here? So the thing is that it can change pretty dramatically, which I think is really actually quite liberating, because what that actually means for most investors is within the space of a really short period of time, the economics of the property are going to change rapidly. And so if you can lock in your price on day one and let the rents shift and grow with the economic environment, you're going to end up in a pretty good position pretty quickly. So I think that's actually quite liberating for property investors.
100%. And, we do valuations on our clients' properties every 6 months. And every 6 months when we see these reports come through, it's just amazing to see the results. And like, the reality of it is, it's life-changing for people. And the one that really sticks out in my mind is we had an early retiree come through. She was looking for something that was going to give her more freedom and choice in her retirement, and just comfort and safety that she knew that she was going to be okay moving forwards, and she wasn't relying on super or a pension. And we managed to find her this absolute cracker of a unit complex, and it was yielding at around 11%. And we managed to secure it for sub 500K. I think it was around 480 or 485 that we got it for. And the email that we got from her, that was just, it really touched a lot of us, to be honest. Totally. Knowing that, what we found her had absolutely changed her life in terms of cash flow and security for her moving forwards. And the best thing about it too, there was multiple value adds that she could have done to increase equity and rent, at the same time. But just, seeing that we actually have a life-changing effect on clients, and knowing that what we're doing is setting people up for the future, and just giving them that peace of mind and ease and freedom and choice and abundance and all that fun stuff. It's just, it's amazing to see.
Totally. So given the current environment, what kind of, I know that we're buying in 5 different states at the moment, and God, I can't even remember how many suburbs we're buying in at the moment, but a decent amounts, about 1% of the total property market. There you go. So if anyone wants to work that out, what kind of price points, because I know prices have shifted a fair bit, like compared to what we could buy, a year or 2 years ago, prices have shifted quite a bit, and also yields have changed quite a bit as well. So what are some indications of the types of properties that we can buy in the market at the moment, and kind of the general kind of like average price points or average yields, just so people have got some idea what to go into? Because I remember there was a period there at like the start of like 2021 where pretty much every property we bought was like over 8% yield. That doesn't seem like that's really going on at the moment. So do you want to give us a sense of kind of like maybe if there's different kind of categories or anything like that, just to give us a bit of a sense of what people can achieve?
Yeah, no worries. I mean, well, last year around, I don't know, from probably July through to October, it was like, you get a duplex, you get a duplex, you get a duplex. Everybody could just grab a duplex. It was getting 8% somewhere. But as you said, those duplexes that we were buying for, say, 300,000 to 400,000 are now 500,000. And as prices go up, yields come down. Obviously, rents are going to continue to increase, but the yield at the yield at the time of purchase is going to be lower than what it was, 6 to 12 months ago. So at the moment, we're finding single family homes, price points, they're all location specific, but generally single family homes are what we're sort of buying the most of at the moment. And these are sort of neat and tidy, brick and tile, low maintenance properties. And we'd be finding anything from, 5.2 up to, say, early 6s in terms of yields. And that's pretty common across the market in general at the moment. But as we've said multiple times, if you're buying yourself a 5.5% yielding property, give it 12 months, it'll be a 6.5% yielding property. We've locked the price in, and the rents are going to continue to increase. So I've seen that across properties that I've purchased as well. And, we map things out on a lower than or a conservative rental increase year on year. So whenever we present a property to a client, they see, a lower than anticipated rental increase year on year. So hopefully we're going to underpromise and overdeliver in these current market conditions.
Yeah, totally. So, single family homes, we're kind of looking, from what I've seen, they're kind of like typically around that sort of 400, 450 mark at the moment. Is that kind of fair to say?
Yeah, it depends where they are. So, we could go up to, say, 600 in some areas, but then there's other areas that we're buying. You can get say a 3-bed, 1 bath for, low 200s.
Yeah. Yeah, awesome. And what do you think? Have you got any advice for any other kind of tips for people that want that are thinking about buying in the market at the moment? How to think about it?
I guess current market conditions are temporary.
Mm-hmm.
So buy with a long-term view. And the way that we do things, we try and do things, up to 6 times faster than your traditional methods of purchasing or traditional methods of property investing.
Yeah.
So, there's more than one way to skin a cat. But the way that we do it is proven time and time again. So I would say lean in, call someone like Dashdot who can give you a leg up in a challenging market.
Yeah, totally. I was just sorry if I appeared a bit distracted there. What I was actually just checking was what the current national rental yield is for houses, because we're buying houses. So what you said there, based on what we're seeing in the market, is you said 5.2 to sort of early sixes or whatever. Just to give some context, the national average rental yield is 3.8%, right? So if the national average rental yield is 3.8%, that means that we are 3.8 to let's just say we'll call it 5.2 on the low end, 36% higher on the low end in terms of the yields that we're getting from the national average, which is pretty good. On average, we get about 71% higher yields than the national average, if that gives anyone some context. So that's
there's still areas, we can still pull 8 and 9%ers out. There's specific areas where we can do that for clients, but they need to have a specific kind of appetite.
Well, it depends on the portfolio strategy, right? Because, just because you can doesn't mean you should, right? Just because you can get an 8% area in such and such location, or just because you could buy a cheaper or a more expensive property, it totally depends on the portfolio strategy and what's right at different points in time and for who and for why, right? And it's not as simple as people think. It's just as simple as going, I want X characteristic in my property. It's actually it's both more simple and more complex. The beauty about the formula E equals MC squared is its simplicity and its elegance. And if you can really cook down portfolio strategy to its core components, it is extremely simple. But that doesn't mean that it's not also complex at the same time. You've got to understand the nuances and the differences and all of that kind of stuff to be able to make that work for you. So I think, yeah.
And also, sometimes yield comes down to a little bit of vanity. You might think, oh yeah, I've got an 8%er, bit of an ego boost, but at the same time, maybe a 5.2 is going to give you more growth.
Totally. So I always like to use ourselves as an example, right? Because a lot of people do, obviously you want yield and growth and all of that kind of stuff. But to your point, right, property investing shouldn't be a 1-year game. It shouldn't be a 2-year game, right? So even I think, even if you want to be an active investor, you should probably be thinking about, and when I say active, what I'm talking about is buying and selling properties as opposed to, doing heaps of work on them and whatever, although Tim obviously had some success doing that. What I'm talking about is like, if you buy a property, rather than holding it for 30 years, maybe you're going to want to sell it at a certain point to reposition that capital. But even if you're doing that, you're probably looking at 5-year cycles, right? Minimum, right? In order to maximize the value you take out of it and make sure that you're actually taking profit, not just covering costs. And so over that period of time, things can change so much. And I like to use ourselves as an example because, we're not out there trying to get the highest yielding properties. I know we just mentioned one, we've got 9.1%. We also bought a bunch of other ones where they've been in the 5s, because where we're at in our portfolio, what's important is that we focus on other characteristics. So yeah, I think it's really important to make sure that you're going into it with the right mindset and to go, okay, what's not what do I want, but actually what does my portfolio need in order to get me to where I want to go? Because that's actually the secret to getting to your goals 6 times faster. So
I think it comes back to that whole instant gratification mindset too, where, yields give you that instant gratification where you think, it's successful immediately. Whereas, if you were happy to go and just play a little bit of a longer game or a midterm game, then it would open up so many more opportunities for you.
100%. Awesome, mate. I loved it. This has been really insightful, really great to hear how things are actually at the coalface, on the ground, buying properties every day with the team. So, mate, it's been really good. Thanks for coming on and thanks for sharing your insights.
No worries, mate. Great to be here.